What's the difference between debt that fuels your growth and debt that actually slowly eats away at the business until there's nothing left? Welcome to the Heartbeat of Money. I'm Jon P. Moffitt, and today we're diving into a topic that's gripping small business owners across the country right now. This is the moment when debt stops being your ladder and starts becoming your quicksand. And here's the truth. It's happening faster and more often in this economic climate than at any point in the last 2 decades. Last time in episode 1, we broke down what I call the interest rate ladder. On one end, you have SBA loans usually ranging around 6 to 10%. They're stable, predictable, and they're designed for businesses' growth. And on the other end of the ladder, you have payday loans at 30, 40, even 60%. The kind of money that almost guaranteed you'll sink deeper the moment you grab it. The takeaway was clear. Some owners are climbing wisely with lower cost of capital, while others are grasping for air under expensive short-term debt. Today, I want to go deeper because this isn't just about numbers. This is about real business, real families, and the emotional weight of carrying debt that feels like a trap. So here's where we're headed today. How do we know when your debt has crossed the line into a toxic territory? We're going to get into that. And why is this happening so much and so often right now in today's environment? And then most importantly, what can we do to reset before the trap kind of swallows us whole? So let's start with the warning signs. How do you know when your debt has gone from tool to trap? Here are 4 red flags. Number 1, stacking advances. You've taken out a second merchant cash advance just to cover the first one. It's like paying off one credit card by maxing out another. Number 2, payment overload. More than 20% of your revenue is going straight towards debt service. That means every dollar you earn, a quarter is disappearing before you ever touch it. And number 3, max credit cards. You're leaning on your credit cards to cover payroll, to buy supplies, and to keep the lights on. And those balances are creeping closer and closer to the ceiling. Number 4, short-term fixes. Every loan feels like a Band-Aid, not a plan, not a strategy, just a patch to stop the bleeding for one more month. If any of those sound familiar, you're not alone. According to the Federal Reserve, most recent survey of small business credit, over 60% of small businesses that applied for financing in 2024 got less than they asked for, or were denied entirely. And here's the kicker. Those same businesses often turn to merchant credit advances or online lenders instead, with an effective interest rate often north of 30%. That's not a business plan, that's survival mode. So now let's zoom out for a minute. Why is this happening so much more right now? First, interest rates are higher than they've ever been. The Federal Reserve has kept interest rates high, that's highest levels in over 20 years. And while Wall Street debates when cuts might happen, borrowing is still painfully expensive. Second, banks are cautious. After the regional banks crisis we saw in 2023, lenders have pulled back. Credit standards have tightened, loan approvals are down, and small businesses, the ones that don't have the huge balance sheets or the national brands, are the first ones to feel that squeeze. Third, inflation hasn't disappeared. Yes, it's lower than the peak in 2022, but for business owners, costs are still elevated. The food, fuel, utilities, insurance, rent, labor, you name it, it all costs more. So let me give you a quick stat. According to the NFIB, which tracks small business optimism, 33% of small business owners said inflation was their single biggest challenge in 2024. So put all that together. Capital is harder to get. Costs are higher than ever. And the gap between what business needs to run and what banks are willing to lend is growing wider and wider. So that's the perfect storm that pushes business owners towards merchant cash advances, subprime lenders, and hard money. And while those products offer speed, they often come with daily withdrawals, sky-high rates, and zero flexibility. What feels like a lifeline quickly turns into shackles. So let me bring these to life. You already heard about Sarah, the restaurant owner who turned to a merchant cash advance when her costs went up and her sales dipped. She thought it was a bridge. Instead, it became a trap. Daily withdrawals, 25% interest. Within 6 months, she was working harder than ever and keeping nothing. Now, let me give you another story. Carlos. He runs a small construction company, 6 employees, 2 trucks, steady local work. In 2023, material costs spike, lumber, concrete, fuel for the trucks. Clients all of a sudden start slow paying his invoices, so cash flow got tight. So what Carlos do? He turned to what seemed like an easy solution, online loan, advertised at instant business funding. The approval came in less than 24 hours. The money hit his account, but the repayment, daily ACH withdrawals. By the time payroll rolled around, Carlos was short. So guess what? He took another advance and then another. Within 9 months, he had stacked 3 advances and was paying more than $20,000 a month in his debt service on a company that grossed less than $1 million a year. The debt wasn't helping him grow. It was dragging him under. Now, let's flip it, because I also want you to hear the other side, the reset story. One of my clients, a retail business owner, was in the same spiral. She had 2 merchant cash advances and was maxed on her credit cards. So we stepped in. We built her a finance profile and we moved her into a term loan at 9%. All of her payments dropped almost in half. Her cash flow was freed up. And for the first time in years, she was able to invest back into her business, not just into debt. And that's the power of the reset. So let's talk how this really works. Not all debt is created equal. There are 3 basic categories for business debt. Structured long-term financing. This is like SBA loans, traditional bank term loans, equipment financing. These are usually lower interest, they're predictable, and meant to support growth in your business. Another, revolving credit. Lines of credit, business credit cards, these can be powerful tools if used wisely, but they can also become dangerous if you're funding operations instead of opportunity. And then high-cost short-term products. Merchant credit advances, online loans, payday style business funding, fast money, but expensive money. And here's the math that traps people. Say you borrow $50,000 with a merchant cash advance. The lender takes a factor of 1.3. That means you owe them $65,000 on the 50, not including fees. And instead of the monthly payments, they pull money daily from your account. Maybe $600, $700 every single day. That adds to $12,000 to $15,000 a month on a loan that was supposed to help you with cash flow. Now, see how backwards that is? That's why so many owners take the second loan, not because they're reckless, but because the structure itself makes it almost impossible to escape. And guess what? The lenders know this. Stacking is part of their model. So what can you do? I want to give you 3 simple steps. Kind of a 3-step framework I call the debt reset formula. Step 1, diagnose. Get really honest about where you stand. How much are you paying in total debt service each month? What percentage of your revenue is going straight towards loans? If it's over 15 to 20%, you're in the dangerous category, or territory, I should say. Step 2, restructure. Shift from short-term high-interest products into long-term low-rate financing. That could be an SBA, that can be bank or line of credit. It might even mean collateralizing some real estate to free up some cash. And step 3, rebuild. Once payments are manageable, use that breathing room to reset operations. Cut unnecessary expenses. Invest in revenue-generating activities. And most importantly, don't go back to the products that trapped you. A lot of people do that. High statistic on that. Now, let me pause here, because this isn't just about dollars. It's also about mindset. Debt carries shame. I've sat across from business owners who were afraid to even admit how much money they owed. They thought it meant they had failed. But listen, it doesn't mean your business is broken. It doesn't mean you are broken. It just means the system is misaligned. You're trying to run a marathon with a backpack full of bricks. So let's reset this. The reset is all about taking the bricks off your back so you can actually run again. And when you do, the relief, the clarity, the momentum, it changes everything. So let me ask you something directly. Does your business debt feel more like quicksand than a stepping stone? If it does, it's time to stop stacking loans. It's time to stop bleeding out your cash flow, and it's time to reset. That's exactly why I've built a resource called the Next Age Wealth Legacy Builder Journey. It's a step-by-step guide that shows you how to restructure your financing, reset your foundation, and position your business for long-term success. So you can check it out. The link's down below. And don't miss the next episode, because we're going to go into the practical part of all of it. I'll walk you through exactly what a business reset looks like, step by step, and how you can put it into motion. Until then, I'm Jon P. Moffitt, and this is the Heartbeat of Money. We'll see you next time.